Amassing enormous wealth is a dream for many, but few possess the discipline and savvy needed to join the billionaire club. However, with strategic investing, even those of modest means can steadily build wealth over time. The ultra-rich didn't make their billions overnight. Their portfolios reflect decades of shrewd decisions and calculated risks. Any average investor can forge their own route to wealth by studying the strategies employed by the world's wealthiest entrepreneurs. The methods that have helped billionaires amass their wealth are revealed in this video, so make sure to watch it to the end. Establish an investing framework. All billionaire investors operate within a framework based on their financial priorities and risk tolerance. Mark Cuban advocates keeping a diversified portfolio based on stocks you understand thoroughly. He also urges restraint. Don't invest based on hype or emotional impulses. Study your options, run the numbers, weigh the risks, and make rational choices. Warren Buffett filters decisions through his famed investor principles, which emphasize patience, avoiding debt, and investing in companies with clear competitive advantages in their industries. Meanwhile, Ron has structured his global empire around one driving principle: pursue only the best ideas and opportunities, even if that means walking away from dozens of bad ones first. Mastering self-discipline and developing an investing filter allow billionaires to act decisively when the right moment strikes. Think long-term. Billionaires never chase quick bucks from speculative stocks or trendy assets. Exceptional wealth accrues from owning quality investments for decades while weathering interim volatility. Jeff Bezos emphasizes taking the long view. Stay excited about possibilities on a 10 to 20-year timeline, not just next week's stock blip. Hedge fund legend Ray Dalio also considers longer arcs, like economic cycles spanning generations. With eyes fixed on the horizon, he nimbly calibrates his firm's positions as conditions shift. Meanwhile, Warren Buffett has held stocks like Coca-Cola and American Express for over 30 years straight. Time and compounding returns have multiplied his stakes into billions. While short-term plays may periodically pan out, billionaires know sustainable fortunes call for enduring patience. Leverage other people's money. The ultra-wealthy build empires by spending little of their own capital up front. Leveraging loans, investors, or credit helps them conserve cash, multiply holdings, and maximize returns. For example, wealthy real estate moguls often buy property with small down payments, using rent to fund mortgages. Donald Bren, Sam Zell, and Stephen Ross have all amassed giant portfolios and fortunes over $10 billion apiece, using mostly borrowed capital. Meanwhile, famed activist investor Carl Icahn takes controlling positions in companies with minimal personal equity invested. By influencing boards to make changes boosting shareholder value, he banks exponential returns from initial amounts as low as 1 to 2% of total stakes. Mastering the art of OPM, or other people's money, lets billionaires control lucrative assets while risking little of their own wealth. Make contrarian bets. The richest investors zig when the crowd zags, seizing rare moments when markets drastically underprice quality assets. Billionaire investor Howard Marks points to British mogul Jacob Rothschild, who made a £100 million contrarian bet on gold in 2001, near its lowest point in 2 decades. As the price of the precious metal soared for years thereafter, his fortune multiplied. Likewise, Warren Buffett jumped on global stocks during massive pandemic sell-offs in 2020, amplifying already substantial gains as markets regained steam into 2023. Meanwhile, Sam Zell has built multiple empires, snapping up discounted real estate during recessions. By having cash reserves and courage during crises, while others succumb to panic, contrarian billionaires bank mammoth returns buying when blood runs in the streets. Go where others won't. Rather than chasing crowded trades, billionaire investors seek fresh opportunities on the fringes. Ray Dalio points to the Bezos-era Amazon as an example. For years, most dismissed internet bookselling as a marginal domain unworthy of attention. Dalio himself scored huge paydays investing in China and commodities during eras when both were deeply out of favor. Meanwhile, pioneering cryptocurrency bulls like Tim Draper and Barry Silbert backed Bitcoin and other digital assets when the space was essentially lawless. Their early risk-taking resulted in thousand-fold returns over the following decade. Today, many view sectors like space exploration, genomic medicine, and green energy as too unproven for prime time. Tomorrow, they may become the world's next generation of billionaires. The greatest fortunes take root where few dare to tread. Tune out the noise. Billionaire investors also share the ability to ignore outside opinions and manias. During the run-up to the 2008 financial crisis, Cyrus Sanati of SAC Capital dodged the imploding mortgage trade by barring underlings from pitching him associated deals, protecting capital as competitors drowned. Decades earlier, Warren Buffett similarly sidestepped the raging tech bubble by refusing to invest in overhyped online stocks with questionable fundamentals. Meanwhile, Carl Icahn has repeatedly come out ahead, betting on the unclearest macro outlooks and simply studying the numbers rather than fixating on swaying sentiment. By developing confidence in their own analysis, billionaires inoculate themselves from distraction. They remain focused on facts, fundamentals, and data points, not flavor-of-the-month fads. Master emotions. With billions at stake, investing prowess also requires managing one's own psychology. Jacob Rothschild treats market lows as times to buy, not sell, an overriding panic that compels others to liquidate. Likewise, Ray Dalio emphasizes reflexivity, spotting how market moves alter sentiment, thereby changing reality. While less wealthy investors are ruled by emotions, billionaires identify these patterns for opportunities. Meanwhile, despite massive stakes, Norwegian sovereign wealth fund chief Øystein Olsen limits risk via strict rules and constraints, preventing even roller coaster markets from pushing them to react impulsively. Above all, the investing elite should remember that fear, greed, impatience, and knee-jerk reactions can sink even proven long-term strategies. Mastery over psychology is crucial to triumphing over turbulence. Conclusion: the magnates of capitalism clinch victory by waging financial battles differently than the rest. With guiding principles, grit, rational calculations, and facts replacing fear, their shields remain raised when others flee. Billionaire investor pedigree emerges over years, but ordinary folks can upgrade their own abilities today. As Ray Dalio noted, if you don't fail sometimes, you're not being ambitious enough. The wisdom of elite money masters lights a path forward through uncertainty toward returns compounding steadily over decades. With the boldness to think long-term and act decisively and minimally, any investor now holds the tools to build enduring wealth for generations to come. Don't forget to like, share, and subscribe for more interesting videos.